The world's central bankers have been gathering in Jackson Hole, Wyoming for the Kansas City Fed Symposium for more than 20 years. The event has a long-wielded and outsized impact, with the magnificent Teton Mountain Range providing the backdrop for many significant global monetary policy developments. This year's gathering is online, but the developments have been no less significant. Fed Chair Powell signed off on an historic shift toward average inflation targeting over time, a development that will see the Fed let inflation and employment run moderately hotter than would have otherwise previously been the case. The Fed usually taps the brakes when inflation starts to rise close to 2% and the economy is approaching full employment. But under this new strategy, the Fed is likely to keep rates low even longer, hoping for higher inflation to make up for past periods of undershooting. The Fed has already committed to keeping interest rates near zero for several years. The new strategy likely extends that even further into the horizon. If the Fed wants to give this policy shift some real teeth, they might even consider increasing asset purchases, since after all, the Fed is not projecting inflation to reach 2% at all over the next 2.5 years. This major change in the Fed's framework was widely anticipated, and markets have mostly taken the news in stride. The real impact on global markets will play out in the years ahead. The Fed's policy shift should cement a supportive global policy backdrop for possibly years to come, and if the Fed keeps policy looser for longer, then we should expect the Aussie dollar to remain stronger for longer. The Aussie dollar has been mostly range-bound so far in August, holding to a rough 71.50 to 72.80 range, but looks set to resume its uptrend. The weak US dollar is one key reason Westpac recently raised its forecast to 75 for the Aussie by end 2020 and to 80 cents by end 2021. The domestic calendar next week is very crowded, but probably not pivotal. Q2 GDP and the RBA's policy decision will be the key headliners. The RBA is clearly not eager to loosen policy further in the near term. GDP too should have limited market implications, with a record contraction of around 7% in the quarter almost assured. We'll speak again next week.